So in today's webinar, what we are going to cover is how the credit rating agencies identify, or let me put it in this manner, how does the credit rating agencies start analyzing companies and how do they reach to a probability of default, which is the first step in the risk modeling. So this is the first thing which we are going to be in this particular webinar. So this webinar's contour is going to be what do we look for in an annual report, because we will be sitting outside. We'll be sitting outside as in we will never have the insider information unless we are working for a bank or for a credit rating agencies. Where do we look for, and with some examples. So that's the primary objective of this particular webinar. What to look for, where to look for, and this is not the exhaustive list because this list goes on and on and on. This is more like the sacrosanct list which you have to look for. There can be other things as well, and we have tried and put this really practical. We have taken a lot of examples, so you will be in a position to understand or grasp something at least. Okay, so let's start with a little bit of theory. What exactly the credit research is all about. So credit research or credit risk modeling primarily works on three particular things. One is PD, which is probability of default. Second is loss given default, and third is exposure at default. So these two will come only if the default happens. Once the default happens, we need to answer that how much is the amount which is exposed, and if the company defaults and it cannot pay, then how much is the loss. I'll give you a simple example. There is a retail customer who has taken a home loan. Now home loan is worth 2 CR, and he has taken the maximum loan, which is, let's say, 80% of the agreement value, which is 1.6 CR. So bank has given a value or loan of 1.6 crore. Now the client has defaulted. So that is the exposure at default. That will come under exposure at default, which is 1.6 CR. But now bank has an option. So bank can sell this home and recover whatever money it can. A similar example is the push and steal acquisition. Whatever the money they could recover, they have already recovered. So that is the loss given default or recovery at default. So let's say bank is able to recover 1.2 CR. So the loss given default is 0.4 CR or 40 lakhs. So need not be if the company has defaulted, then the entire money is gone. So it is not the case. It's just that the time which it takes. So because if banks try and sell this particular house and it is not their primary business, they will sell it at whatever price they get, and they will basically get out of that property or basically get out of this non-performing asset, because it is anyways not going to create any kind of an income for a bank. So bank usually sell such assets at a lower price so that they can get out easily, and in the process they take some hit. So exposure and default and loss given default has some correlation also. So covariance variance matrix is also used in the entire process, but this is not the discussion for today's webinar. Today's focus is on probability of default. How do we find a probability of default? How often or how likely this particular company or an institute will default? What is the probability? In the meantime, I have some questions. So moving on, this is what we exactly. Okay, let's understand this. How come the loss given default is 0.4 CR? My asset value was 1.6 CR. The client defaulted. Exposure was 1.6 CR because client cannot pay 1.6 CR. Hence, bank sold this property for 1.2 CR. Bank recovered 1.2 CR from 1.6 CR, which was initially given. So there was a loss of 0.4 CR, which is 40 lakhs. Hope this is clear now. All right. So now how do we assume the probability, or how do we calculate probability of default? So about that, there are two things. First is ability and second is willingness. So ability is through the financial statements, primarily from the financial statements and business risk. We'll be able to understand the ability and nature of business and whether the company can pay. So that's kind of an ability where the company has enough finances or enough cash flows to pay the debt basically. Willingness is whether company will pay, like a Kingfisher as an example. Kingfisher can pay, but they are not paying, or the promoter can pay, but they are not paying. All right. We will primarily focus on financials, but we will go through willingness part as well. There are some parameters which we will look at the willingness, or which will explain the willingness part of it. Within that, there are some quantitative and qualitative parameters. Willingness is primarily qualitative, basically on historical parameters. In the financial part, we can have future projections. Over here, we just have to see whether the company has ability to generate enough cash to serve the interest. I repeat it again. If my revenue is 100 and my profit after tax is, let's say, 20, and my interest obligation, or let's say profit, or rather PBIT, profit before interest and tax, is 20, and my interest component on the debt is, let's say, 25. So here it directly says that I cannot pay this 25 as a debt because my operating profit itself is 20 rupees. How will I able to pay my debt? So that's a part of this quantitative analysis while we are calculating a probability of default, which is a financial risk. Now, what kind of risk? How do we analyze that? We will see. We have primarily taken in this particular webinar, primarily taken the examples of infrastructure companies. Infrastructure companies are extremely useful when we are doing a credit research or credit analysis, because it gives a lot of information, and from the understanding perspective it is remarkably because there's a dearth of information. There's no dearth of information, is already available there. We just have to understand the nuances. That's pretty much. Let's see, let's understand one by one at a time. So the first is, we will start with the management accountability, and there are different sections which we have divided. So management or a promoter do have some accountability towards the shareholders or towards the debt holders. If so, that will come into willingness. If they are not willing to do a particular thing, then there is absolutely no way. There is absolutely no way we can recover any kind of a debt. So we have taken two examples. This first example is of Supreme Industries, Supreme Infrastructure, rather not industries, Supreme Infra. So here in the annual report, barring the first three statements, which is balance sheet, profit and loss, and cash flow statements, there are all lot of other statements, or the information is available not necessarily in the tabular format. So we can look at this. So this I have taken from Supreme Infrastructure annual report, from the section of summary of significant accounting. Now, why this is important is they have given a lot of loans to the subsidiary companies. So let me give you a backdrop what Supreme Infrastructure does. Supreme Infrastructure primarily into road and bridge construction, which they get 60% of their revenue from, and building construction. Uh, They have lot of companies because every time they prepare a road or build a road or a bridge, they create a small subsidiary company. And that's how the industry works. That's how the infrastructure industry works. Now, whenever you give intercompany loans, you have to charge some debt or interest on that debt. You are giving debt, but you have to charge some interest because that's an opportunity cost for a company. So company A is giving some money to company B. Now equity investors would have given money to company A to expand business. Now company A decides to give some money to company B. In return, they are not asking anything. So that is absolutely fine that you should give, you should promote, but in return you should get something. Otherwise, the equity investors of this company A will get disappointed. They will get lesser returns. That's natural course of business. But here the companies have given interest-free loans. That's a first red flag. This should not happen in any case. And there are a lot of companies in this particular, or at least in Indian equity markets, where interest free loans are given to a subsidiary companies. So that's the first red flag. Second red flag, this I have taken from KNR Constructions. Again, the construction business, where it says that they have unsecured loans received from companies. So K. Narasimha Reddy is the promoter. They have received an unsecured loan of 80 crores and 46 crore. This is the latest year, 2017 and 2016. On what basis? Absolutely no idea. Why it has been given? Absolutely no idea. They have paid unsecured loans over years. So out of 80 crores, they have paid 2 crores, or rather 3 crores. Why they have taken 80 crores? No idea. What will they do with the 80 crores? No idea. So that's a second red flag. So which comes into management accountability over here. So which is more on the willingness front, Now, just to give you an idea, the companies which are there, or credit management or credit risk companies, analyze these primary parameters. These are again not exhaustive parameters. This does not include everything, but this is more like a sacrosanct parameters. You have to look at it, and based on this, the companies or the credit rating companies give a particular rating. So they start with the country risk. Usually for the country risk, they provide 10% of the weightage. Rest 90% of the weightage is towards the business and a particular company which is under a consideration. Now, again, CRISIL may give a weightage of 10-90%. ICRA may give 15% and 85%. That percentage is not known unless you are in the business. So as an outsider, you have to go with your hunch basically. The question is, the profit from company B will be transferred to company A, which is their return. Here, the company A has given a debt. It has not given an equity. So company A is not an equity owner, by the way. Company A is the debt holder. So that's why there is no return from the profit. The return will only be on the interest. Hope that clears your answer. Okay, so these are the parameters which companies will take you through. We were discussing the percentage, 10%, 90%, that nobody knows until unless you are in the business. So currently, we are discussing this management ability. So the management ability is basically, if the management is extremely good, then they will have a score of 5, or otherwise they will have a score of 1. Now depending on your judgment, you have to give a score over here, or a company will give a score over here. So for example, we have discussed the loan part of it, which will come under corporate strategy, how the management treats the equity or debt holders. All right. Um, Moving on, there is a second case over here where the management takes some decisions to lure or to influence the stock prices via dividend. So basically, this is an appeasement towards the equity holders. But if you go hierarchy wise, the debt holders have the primary responsibility, or debt holders will have the first priority if there is a liquidation, because they have the minimum risk, or they have the lesser risk than the equity holders. However, this example is of Kesoram Industries. We are not getting into what this company does. We are just here to look at the parameters from the debt perspective, from the credit perspective. So we are not projecting any revenues over here. Now, if you see, this company have made losses. Company has made losses. So which is fine. There is absolutely no issues with that. Company may suffer some issues. But if you are making a loss, then you should not be paying dividends. So this is a profit and loss statement. This is profit and loss statement. And the second statement which I have taken the data is the cash flow statement, financing activities. So post profit and loss statement, there will be something called as cash flow statement. Within that, there are three kind of cash flows: cash flow from operations, cash flow from investing, and cash flow from financing. These are the most three important statements which we usually overlook, and not because we don't know, it's because most of us are not comfortable initially. So, company is making losses, but company still decides to pay dividends. Why? Now, where this dividend will come from? So in the normal course of time, there is a profit, let's say 100, and out of which company decides to pay, let's say, a dividend of, let's say, 20 rupees. That's fair. That's perfectly fine, because company decides to give some money to the shareholders. That's perfectly fine. But if company is making losses, how they will fund their dividends? By taking debt. Companies will not explicitly state that, but it's up to you, it's up to the analyst. You have to figure it out that it's a loss making entity and company is still paying a dividend. There is definitely some issue. So that's a second red flag, which will come under corporate strategy. That's a decision which firm is taking, that to provide dividend. Companies do pay from reserves and surplus, but it was not the case, and hence I have taken the example of Kesoram Industries. Third, management accountability in terms of salary. Most of the companies, this is again an example of Kesoram Industries. Most of the companies, whenever they are making a profit, they will increase their salaries. But if the company is making loss, lot of companies, and if the loss is for a particular year, then that's fine. But if the loss is sustained. All right. So some companies, despite continuous losses, they keep on drawing the salary, which is again a red flag. Companies should refrain from doing that. So, for example, if you take an example of Supreme Infra, last year they did not withdraw any salary. They did not withdraw any salary. But in the example of Kesoram Industry, it is not the case. So that's the only thing which I'm trying to draw over here. If you look at Manappuram Industries or Manappuram Finance, Professor Sanjay Bakshi was very impressed with the kind of treatment he gave to his daughter when the daughter joined the business and the kind of remuneration he provided. Same was the case with Ambika Mills, Kaveri Seeds. There are ample of examples where this was adjusted. If the profit is increasing, then only the salary will increase. If the profit declines, the salary will also decline. In this particular case, it is not so. All right, so let's move on. The final in the management accountability is the risk taking ability. So this is the example of Subex. The only thing which you have to keep in mind is the sales. If my sales in the range of 400 and 500 crores, definitely my profit will be in the range of 20 to 30 crores, 10 to 15%, 20%. Even if it's 20%, so let's say 80 crores. Alright. So if my sales is 400 and 500 crore, my profit after tax would not be more than 30-40 crores. Let's say max 70-80 crores. My profit is not positive. So this premise does not work. For the most of the time, my profit is negative. Alright. Then the company till 2015 and 16 used to acquire lot of companies through debt. It is the classic example because Subex during 2007 and 8 was a hot property, was a good stock, and then currently the stock is trading at 6 rupees. Exact story. The only difference, exact story as Tata Steel, the only difference is Subex never had a backing. Exact story as Tata Steel. Tata Steel wanted to acquire Chorus. Initial bid was of $8 billion. They raised that bid. To this is a profit. This is PAT. They raised their bid to $13 billion, and they are still struggling till the time they decided that they will sell off Chorus. The only thing is Tata Steel had a backing of Tata. Subex never had that backing, so that was an absolute risk, an absolute blunder on their part. So that will come under execution ability, whether I'm able to take the risk and execute properly. Salary we have covered, risk taking ability and execution ability, which we have covered. Now coming to the business risk. So country risk will be standard for all the companies which operate in India. Now we have seen the management risk. Now we will see the business risk. Let's understand this. In the infrastructure business, there's a lot of regulation which plays, and because of that, most of the companies take heavy debt and then they are not able to repay it. Again, this is the example of Supreme Industries. Supreme Infra. I keep on saying Supreme Industries. Supreme Industries is a different company. This is Supreme Infrastructures. Under the section where the finances were mentioned, they have clearly mentioned that companies' financials were under severe stress on the account of several factors like delay in execution of projects. So execution capability is at risk. Delay in land acquisition because of regulation. BOT project is a terminology which is used in the infrastructure project. Build, operate, transfer is a kind of a model which they operate. So I'm not getting into the model part of it, how the business actually is running or runs. Cost overruns on delayed projects because they have to pay the salaries and everything. High interest cost because they will keep on defaulting. Vis-a-vis volume of the company's operations, stressed working capital finance, and similar factors peculiar to the infrastructure, and that comes under regulation. If you cannot manage and if you do an aggressive growth, then there will be a problem for sure. After that, look at the credit rating, and the company is clearly mentioned, has been assigned in D by India Ratings. Basically, it's a Fitch associate for the long-term facilities, cash credit facilities, and non-fund based limits of the company. If you have D, that means you are not even investable grade. You have basically entered into a default category. That is justified, or that is displayed in this particular section, which is indebtedness. It says that what is my principal amount at the start of the year, interest accrued or due but not paid, and then how much addition I have done. So this is not the addition per se. This is not the new interest. This is basically an old interest with the interest. Old debt with the interest. So if you look at the financial statements, no new loan have been granted, but exactly the same premise where Kingfisher defaulted and they wanted new loan, they wanted restructuring, and restructuring happened. The same case has been explained in the previous video, which is on credit assessment, not in depth, but it has been discussed over there as well. So that's on the regulation front. Now comes the diversification, how business is diversified. So this is very simple. I've taken an example of TCS, Mindtree, and HCL based on the client list and the amount generated from the clients. I have taken three separate or three companies. So for example, TCS has a revenue of, let's say, 1 lakh crore. HCL has half of it, around 30-40,000 CR, and Mindtree has around 5-6,000 crores. Look at the breadth or the diversification in terms of the client. Diversification as in what is my client spread. Look at this, 100 million plus clients in a year is 38. Look at this, for the Mindtree, this 100 million plus client was converted this year. Look at for HCL. This client list you will get from annual report, but they will never give you directly. They would have mentioned somewhere in the notes section, so you have to read it properly, where they have mentioned about revenue. It will not be given directly. Infosys is pretty straightforward. Infosys gives everything in a tabular format, and that's why I've not taken example of Infosys. That's why I've taken example of in TCS, Mindtree, and HCL, because you will take time to gather all this information. By the way, whatever information I display through our webinars will be a public information. There is no confidential information, because we ourselves will not have access to that, or we are not supposed to disclose it. So whatever information is available is definitely available in the public resources, either through a news item, magazines, annual report, analyst transcript, analyst presentation, from website, from multiple sources. Need not be only annual reports. Continue with the diversification. We have taken the market position example as well, as in how a particular company is have cushioned themselves from a particular from a particular industry. So to continue here, so 100 million plus client is, so $1 million is 7 crore. If I have 100 million, then it will be around 700 crore. Look at the revenue for Mindtree. One client generates almost 1/7 of company's business, which would be around 12 to 13%. If this client goes off, huge impact on Mindtree versus TCS or versus HCL. Huge impact. If this two client goes off, that means 1,000 crore gone straight from the revenue. we don't know the reason. Reason can be anything, but as a credit analyst, you have to understand these nuances, what exactly you are looking for. So that will be a part of diversification that is mentioned over here, diversification in the business. So you can have 5 ratings. So usually companies have AAA to AA to A, similarly for triple B, similarly for triple C and D. So there are going to be 10 ratings. From that premise, I have taken scores from 1 to 10, and if there are 5 scales, then each scale will have a score of 2. Now that is completely up to you what exact score you are providing. But if it is Mindtree, then I am 100% certain that you will not provide a score of, let's say, 8 or 10, probably 4, 5, 6, not more than that. All right. Coming to the sector which the companies operate in, look at the diversification by TCS, and there are some of the examples. So I have taken L&T for this particular reason. L&T is pretty strong in BFSI. L&T is pretty strong. They get a lot of projects. Retail, Mindtree gets a lot of projects. In BFSI, they get a lot of projects, and in travel and hospitality, they get a lot of projects. Manufacturing, HCL get a lot of projects. Now, if this any particular sector is hit, if this also, so let's say BFSI is hit badly, and the new projects stops coming in, then what will happen to L&T's revenue? That's where the stress testing comes into picture. So as a credit analyst, so again, we are not going into a stress testing because that will require a lot of forecasting. So if you are doing a credit research for L&T Infotech, this is L&T Infotech and not core L&T, which is into a manufacturing business. This is L&T Infotech. And if you do a stress testing, and there will be and if you project that there is going to be some issue, so let's say for with a manufacturing company or a retail company, and there is an impact to L&T, and then through stress testing you can try and understand what is the impact on the overall revenue, and eventually what is the impact on overall cash flows. That's where the market position comes pretty handy in this particular sense. Again, this all information we have taken from annual report. We would have calculated. It is not like that they would have given everything directly. Some of the companies will give direct, some of the companies will not give it direct. So you have to calculate, you have to spend some time on that. Over a period of time, I suspect that once you get familiar with a lot of annual reports, this should come very handy. This is just creating a base. Moving on, the financial statements. Now, some of the things we can directly identify from the financial statement. Some of the things we need to calculate. So now this is the example of Bhushan Steel. Very recent example. We can directly calculate that default from P&L and cash flow statement. We could have easily done that. Easily. There is absolutely no issues. It's the only thing that we have to look at multiple statements simultaneously at the same time. So very neat example, finance cost, which is mentioned over here, which is amount in lakhs. Finance cost is 5 lakh, whatever million crore, it is surely not crore, but whatever is the amount which is over here, 5 lakh million, let's assume that, and finance cost last year was 4.6 lakh million. Now, company is supposed to pay this. The answer is yes, because they have accounted in profit and loss statement, and that's how they have got a loss. Profit and loss statement is not the ideal way to look at the finance cost. You have to confirm whether they have paid this much amount or not. So you go to a cash flow statement, cash flow from financing activity, and there will be a line item mentioning interest paid. Look at the interest paid. So they were supposed to pay the interest. This finance cost is primarily made up of interest, but look at the interest paid, which is 1/4. So they defaulted on debt. They defaulted on interest as well. It was a straight catch. Now, if such company comes to you or comes to a bank, ideally you should not provide any further debt. Any further debt. Still, companies provided a debt. Look at this. Proceeds from short-term borrowings. Proceeds as in the money which came in. 93,000 million amount, some amount came into the kitty of Bhushan Steel which shouldn't have happened. This is technically giving money to a company who has already defaulted but have not recognized. Basically recognized as in they know they have defaulted, but see the example. Finance cost, it was 4.6 lakhs and they did not pay here as well. So they defaulted on debt previous year only, they defaulted on interest previous year only, still they received a debt 93,000. First thing, why is the question? Who did this? It was under somebody else's influence, we don't know. But as a credit research analyst or credit risk analyst, we need to understand this. This will go under finance, which is leverage part. So again, so we have provided some parameters. So there company can have leverage parameters. If the leverage is, let's say, more than 5, then it's a bad. Leverage is less than 1, then it is good. Companies can have parameters, and that's why we have left it blank, and we have given some examples over here: growth and profitability. Capitalization of interest. This is a very interesting example. Now coming to the capitalization, let's understand few things. Why I say that uh, taking interest from profit and loss statement is not advisable. So let's understand this. If I have to find the interest cost, or let's say I have to find interest coverage ratio. Understand this lot of companies do that. Again, you will say this shouldn't be allowed, but yes, technically as per the laws it is allowed. It is not a fraud, so mind that. If you have to find the interest coverage ratio, is basically EBIT upon interest. It says that through my EBIT how many times I can cover my interest. So this will come from profit and loss statement, and this will also come from profit and loss statement. Let's see the impact. Alternatively, if they ask me to calculate the interest cost as well, interest cost, as in at what rate all loans are, average rate which they would have gotten all the loans. So my EBIT from P&L statement for Hindalco, this Hindalco is 2013 annual report, is EBIT is going to be, let's say this is 3980 plus 2000, so 3980. EBIT is earnings before interest and tax. They have not calculated, so let's keep that part and understand the interest cost, because we need to do a calculation over here for EBIT. So I will skip that part. You will understand the same thing if at all you are doing at your wish. Interest cost. So in the denominator it will be all loans, and on the numerator it will be all the interest. So here the interest is going to be 2000 crores. These all figures are in crores. 2017, let's say 2100 crores. Loans, so this I have taken from P&L, and loan I will take it from balance sheet, and that's what it is taught. So interest, loans would be from balance sheet, so which is over here. Long term, which is 50,000 crores, plus short term borrowings of 6,000 crores, which comes to around, let's say, 55,000 crores. So if you do the math, you will encounter that this is at 3.8%. This is 3.8%. Don't look at this. Don't look at this because we need to calculate this. Instead, do this interest cost. The interest upon loans 2,100 crores upon 55,000 crores, which is 3.8%. Now, a lot of you might ask a question saying that Government of India borrows at 6 and 7%. How come Hindalco, who is more risky, borrows at a lesser. Again, a lot of people will say should be the average. It will not make any difference, which is 49,000 plus 37,000. So assume that this is 50,000 crores. So this will become 4. This is just for an illustration purpose. Answer will remain the same because interest would be around that. Um, but even in any case, Government of India borrows at 6 to 7%. How come this is the figure which Hindalco. The second thing people will say is they would have got foreign currency loans, which is not true. Some of the loans were foreign currency loans, but let's understand whether this figure is different from cash flow statements. If we go to a cash flow statement, again cash flow from financing activity, which is investment and financing, you will see finance cost paid is to the tune of 3,700 crores, and then divided by 50,000 or 55,000 crores. So if you do the math, you will now understand that this loan will be at around 6.72%. So now I can understand that there may be some foreign currency loan, but what is the reason why this loan or why this interest manipulation? Is this a manipulation? No, this is called as a capitalization. That means some of the interest you can consider as your capex, and as and when you complete, you can take this interest, but you have to pay it right now. So in P&L, they would have done this kind of a jugglery, which is called as capitalization of interest. So this again is a red flag. This is not a fraud, but yes. Coming to the qualified opinion, which is again the example of Supreme Industries, Supreme Infrastructure. Qualified opinion. Qualified opinion. So this is again Supreme Infra. This usually is offered by the auditors. So if you say, or if you see here, they have provided a qualified opinion. Qualified means something they did not see correct. So it shows that standalone financial statements, the company's trade receivables and unbilled work worth so and so amount were closed, terminated, uh, where the matters are currently under negotiations. Okay, they said that they will recover, but they could not find any justification from where it will be recovered. So this kind of a qualified opinion, not every company will have qualified opinion, but yes, some companies will have this kind of qualified opinion. You have to look out for. This is again a big red flag, because now the auditors have mentioned that. Similar thing has happened with PC Jewelers and Vakarangi recently. Moving on, something interesting, which is you have to look for current investments. So we usually ignore current investment are the liquid ones, but you have to look at this current investment very carefully. Exactly the case happened with PC Jewelers and Vakarangi. It came into limelight because Vakarangi bought some share, some person, 100 crores worth of shares of PC Jewelers, and it came into limelight. However, not all the companies, but some companies do invest in equities. For example, this company, again Supreme, look at their investments. They have invested in long-term equity fund, they have invested in gold fund, and they have invested in CAPROS, Capital Protection Fund. Though the amount is small, 24 lakhs, some 20 lakhs, some 33 lakhs. The question you need to ask is, why are they invest? Why are they investing in equities market where their main business is into infra? Question. So as a credit research analyst, when you will meet a company's management, you need to ask this question. As an outsider, I don't know why they have invested. But if I go and meet this company, I will definitely ask this question. Again, a big red flag. Why? Why are you investing in others' company? If you have excess money, return it or repay your debt. Why are you keeping this money? Or invest in liquid funds. Why lure for higher returns? Liquid funds are the easiest ones, 7-8% straight return. Why lure for higher investments? Straight red flag. Straight red flag. One of the most critical thing is revenue not received. You have sold some items, you have recognized it, as in P&L you have recognized it, but you have not yet received. I've taken an example of Supreme and KNR construction. How do you find this? So in the current assets, okay, means I have sold something but I have not yet received. So this is basically the pending revenue from mine. So if you take the percentage, and this usually happens, and that's why we usually focus on working capital. I'm not getting too deep into working capital, whether it is positive is fine or negative is fine due to paucity of time. But if you take a percentage out of it, so this is more than 11-12%, and this is less than 8-9%. So surely KNR construction has some edge over Supreme Infra. But how do you find this? It's an unbilled revenue. So you go to this particular current assets, and there will be unbilled work. This is the unbilled work which they are yet to receive. They have sold it, they have recognized it. That means in the P&L statement they would have mentioned that this is my sales, but it's an unbilled. They have not received money. Okay, so this is again, this is not a red flag, by the way. Sales over invoice, yes. You have done the sales, you have issued the invoice, but you have not received it. So this will go into receivables in balance sheet. Somebody was asking what is the connection between balance sheet and profit and loss. There are a lot of connection. So this will go into receivables. Sales is done. Profit is booked as in you have displayed that you have done so and so profit, but this will not go into receivables. This will go into receivables, and then eventually it will go into cash flow, that we will see. When you are doing a cash flow projection, basically you are doing it for a company, so you need to understand how frequently the company, whenever you are doing a projection, because you need to understand whether I'll be able to get my money back from the future perspective, because they would have taken some money. So some companies do that. So again, I have taken an example of Supreme. They have given this project details. This is not available in annual report. This is in analyst presentation. This is in analyst presentation. Now, you don't need to go too deeply into this if you don't have time, but you can simply overlook. So this all figures are in millions. So that means sanctioned debt for this particular project is 4132 million or 413 crores. And they would also mention that average revenue is 9.44 lakhs. This is in lakhs, this is not in million. So this is basically 1 million every day assume. So this is basically 4132 million and 1 million. So in a year, my income is only 365 million versus the debt of 4132. If this debt at 10% Then my interest cost is 413 million, which is higher than 365 million. How will I repay my interest in the first place? And who gave this loan? Question mark. These are the kind of questions you need to answer, or you need to ask in the first place if at all you are doing a credit research. Receivable issue. Now some companies do jugglery. This is a pure miscalculation, or I would say representation. This can be considered as a false statement. So I will not be able to cover self-sustainable growth rate. Probably if we have time, then uh, I will put up a video on this separately. So this is company A, and within that subsidiaries, basically standalone financial statements and consolidated financial statements. Now ideally, I'm supposed to receive some money. I've received it, but I've not paid it. So that's the classic example. So this is a standalone financial statements. So they have sold it something. They're supposed to receive this much amount, 1.06 lakhs. But if you go to a consolidated statement and if you go to a receivables, that is 1.02 lakhs. That means there are some subsidiaries which have not paid to this standalone entity. So on a consolidated level, I am supposed to get 1.02 lakhs, which is basically from the outside. But if I look at only the standalone balance sheet, so they would supposed to get 4,000 lakhs from subsidiaries which they have not got it. That's the issue. That's the red flag. That's the misrepresentation, miscalculation. You can term it whatever you want. Analysts do miss this. Most of the times, analysts do miss this. I have never seen in this, at least in any of the credit research report, that they have done this. They have missed it completely. There are some. So this is MBL Infra. You will get a lot of other information. This is very simple. In the liabilities, there's something called as checks overdrawn. So that means they have overutilized bank facility. That means they are on the verge of default. Keep a watch. They are on the verge of default. Keep a watch. So this was last to last year. In the subsequent years, they did pay, but it was under a watch category. So this is again a red flag. Now, I will directly jump to the question.